Welcome to Transfer Pricing 201, Transfer Pricing for Tangibles. In today's video, we're going to be talking about the profit split method. We've already talked about the other methods that we use for tangible goods, including the CUP and the cost plus, the resale price method, and now we're talking about the profit split. We also commonly use the comparable profits method, but that's the subject of another playlist and videos. So the profit split method, actually there are two profit split methods. There's the comparable profit split and the residual profit split. So in a situation of a comparable profit split, essentially you're going to split the operating profit between the two controlled parties, or more than two if the case may be, in proportion to how you've seen and have been able to observe a profit being split by unrelated parties. Now, frankly, it's fairly rarely observed that people ever split a profit. I can offer up one example, which might be a hedge fund manager. Hedge funds generally charge their investors two fees, one of which is a small percentage fee, 2% of what is invested in the fund every year. But then they share the profits where the hedge fund manager earns 20% of the profits earned above a hurdle rate. Well, that would be essentially a comparable profit split that one might be able to use if two related parties were arranged in the same sort of transaction. But we just really don't generally see people split profit all that often. And often it's because it's very hard to do this. You would need to be able to make sure both parties can audit each other's results to make sure that they're not somehow overcharging the system. So if you and I agree that we're going to split the profit, I become very concerned with potentially what costs you are allocating to the particular business that we're doing together. And I might worry that you over allocate costs to the business, getting a compensation for that, and then creating a smaller profit that we're going to split. So in general, when unrelated parties transact, they're going to do a revenue split. And we don't really have a transfer pricing method for revenue splits. The one that we do more often, though, is the residual profit split. And this is where all of the parties are first rewarded for a routine return on the activities that they've undertaken. And then if there is a remaining portion of profit, it is split amongst the parties who've created it in proportion to their contribution to creating that profit. Since that's the one that we use more frequently in practice, we're going to focus on that much more than we do the comparable profit split. So, essentially, going back to that format that we've talked about before, this is a method that evaluates whether the amount charged in a controlled transaction is arm's length by reference to the splitting of the profits by uncontrolled parties in a comparable transaction, that's the comparable profit split, or by the resulting splitting of the residual profit after routine functions have been compensated by a reasonable measure of the contribution of the two parties. Now, all these are summarized in the Treasury Regs 42-6 or in the OECD guidelines. This method is particularly useful when the two parties to the transaction are so interrelated to each other in how they're creating value that it's hard to separate the two. I'll give you a quick example of that. In the financial world, you sometimes have a single book of securities. The most common is foreign exchange options that are traded nonstop 24 hours a day by teams in different locations around the world. So often you have a team in London, a team in New York, and a team in Asia where they pass the book, so to speak, from one location to another. At the end of the year, the book has made a certain amount of profit, and then you just split it amongst those locations, usually in proportion to the total compensation, including bonuses, paid to the traders. That gives you a sort of idea about how this might be working, where something is so interrelated it's not feasible to figure out what any one trader earned. It can also be very useful when both parties to a transaction have valuable non-routine intangibles, in which case it's very hard to reward one side of the transaction as you might with many of the methods we use, like the resale minus or the cost plus or even a CPM, because it's not taking into account what the other side of the transaction, I should say, what it's failing to do is, one, you won't be able to find a good comparable for somebody who has an identically valuable intangible. And both parties have important intangibles, so in a way it's easier or it's more appropriate to say we're going to split up the residual profit, the amount of profit that they have in proportion to those two intangibles that they've been creating. So the steps in a residual profit split is, first off, you have to start with the overall profit. How much is being earned by all of the parties that are in the chain of transactions that create the profit? Our simple example we're going to keep returning to is our Japan Co. UK Co. example, 2 parties to that. And in total, they've created 15 of operating profit. So the first off would be to make sure we understand fully how that profit was created. And then to remunerate routine activities first. So we're going to give a sort of base rate of return. Often it's a cost plus markup on costs, or it might be an operating margin for a distributor, or return on assets if someone's got a lot of assets in a business. And once that's done, we then ask the question, is there a residual profit or loss? Hopefully a profit. And we're going to then allocate that profit amongst the parties in proportion to how they contributed to creating the value. Now, how will you exactly measure that economic contribution? There are various different suggestions that you'll find in the regs. You could look at the assets used, the risks taken, the functions performed, and maybe measuring the functions by what they cost to perform. It can be a bit of a challenge, especially if the contribution is an intangible. In that case, we're often looking at the cost that went into developing the intangible as a proxy for the value of the intangible. The common strength of the profit split method is that it generally it doesn't require that you are able to observe really close comparable transactions. You do have to have them for the base rate of return that you use before you get to the residual, but then you just split the residual based upon a reasonable measure of the contribution. And one of the big advantages here is that it's unlikely that either party to the transaction is going to be left with a very extreme or improbable result. So if you end up using a CPM and you didn't take into account a profit split method and there's a sudden surge in profitability, it may be such that all the profit is going to show up on one half of the transaction, because the half that you establish the pricing with some sort of comparable profits method may be held to a very low rate of return. That can be a very hard thing to explain away to a tax authority who says, I don't understand, this became a wonderfully profitable business, but somehow you earned all the money in the other jurisdiction. Now, the weaknesses of this is that, well, one, first off, you're going to need more detailed information than you may have had in other types of analysis, because you need to understand the profit and loss statements from both sides of the transaction. And one of the issues that can come into play is also, are both financial statements from both sides of the transactions done under the same accounting methods, or are there any different standards in how the profitability is being calculated in each of the 2 jurisdictions? And if so, how does one take that into account when determining what's going to be split? Well, that's the end of the introduction of the profit split method, and we're going to next go into some videos that have examples of executing a profit split method, basically variations on our Japan Co. UK Co. case, so that you can see how it would actually work. Thanks, have a great day. Again, give us a like or a comment if you can suggest something to improve the videos. We appreciate the feedback.